Hi, welcome back. In this session, I'd like to talk about Tesla, a company I've talked off and on about for the last few years. In fact, about a year ago, in July of 2016, I described Tesla as the ultimate story stock. What do I mean by this? I was trying to explain the phenomenon that when Tesla they had a misstep when it could not meet its delivery requirements or something happened to the company, the stock price did not seem to miss a beat. And my argument was that the underlying story that investors were betting on was so strong that they were willing to overlook the small missteps. In fact, in that post, I described all of the choices you had when it came to thinking of the Tesla story, starting with what kind of business is it in? Is it an automobile company, an energy company, a combination of the two? Is it going after a mass market or a luxury market? What are its competitive advantages? And I argued, depending on the story you told about the company, you could end up at very different values. In fact, I put this into numbers by looking at the choices. In this table, for instance, I've estimated the value per share in July of 2016 for Tesla based on the story you were telling about the company. The story about whether it was an automobile company or a technology company, a company that was going after a luxury market or a mass market with strong competitive advantages or weak ones, and the values range anywhere from the company's worth close to nothing to $316 depending on how big your story was. And my point was to illustrate that with Tesla, it was a story that was driving the value. Well, it's 13 months later, and the story has expanded. In fact, the stock price has continued to go from height to height. Remember that $316 maximum value that I came up with the company? The market took that number and blew right through it. In fact, on the day, yesterday, when I valued the company, the stock price was at $365 per share. Clearly, the market likes whatever Tesla is doing. And since much has happened since my last valuation, let me take a look at what's changed at Tesla in terms of operations and how that plays out in a new valuation for the company. Now, during the course of the last 13 months, as Tesla's market price has increased, it's actually leapfrogged over its traditional competitors, the competitors who've been around for decades in this business, the automobile companies. In fact, Tesla is now worth more in market value terms than GM and Ford, two companies that used to be the centers of the US economy. And for a short period in June of 2016, Tesla was actually worth more than BMW, the fourth largest automobile company in terms of market cap. In fact, even right now, Tesla is the fifth largest company in terms of market cap. And that surprises people because in terms of operating numbers, Tesla is not quite there. Not quite there in what sense? Well, if you look at the number of cars or the revenues that Tesla produces, it's a pittance relative to the other 9 companies on this list. In fact, if you divide the enterprise value for Tesla, and you could divide market capitalization if you prefer just the value of equity, if you just divide the enterprise value by either the revenues or by the number of cars that these companies sold over the last year, you can already see why, if you are a traditional value investor stuck on metrics, why Tesla looks like it's vastly overvalued. Now, I'm not a great believer in these simplistic metrics because they can be misleading. They can make young companies, growth companies, always look expensive. So let's take a look at the numbers for the company. As of 2017. Tesla's had an incredible run. Incredible run in what sense? Well, it started from nothing a decade ago, and over the last decade, it's increased its revenues to more than $10 billion. The number of cars it sells, it's 94,000. Still nothing compared to the bigger automobile companies, but that still is from nothing. That's the good news. The bad news is the company continues to lose large amounts of money. In fact, in the most recent 12 months, it lost more than $635 million, and that's just the operating loss. Its net loss is even larger. Clearly, the company is delivering, at least when it comes to revenue growth, even though it might not be making money. So let's take a closer look at the bigger change that Tesla has created. When Tesla first came on into the business, the other automobile companies essentially viewed it as not just a newcomer, but a newcomer that did not know the facts of life. The facts of life that they knew, that this was a tough business that required huge investments, that that new entrants didn't quite make it. They had a history of 40, 50 years to show where no new automobile company was able to make it through that process and become successful. So their point was, hey, you learn, and once you learn, you're going to discover that this is a much more difficult business, and you're going to go out of business. Well, Tesla's had the last laugh on this because 10 years later, it's the rest of the business that's changing because of Tesla, not Tesla changing because of the automobile business. Changing in what sense? Well, if you look at recent announcements from Volvo announced that it was going to phase out its purely internal combustion engine cars by 2019 and shift to hybrids and electrics. That would have been almost unheard of 4, 5, or even 2 years ago. Ford just replaced its CEO. Why? Because he wasn't forward-looking enough. Increasingly, the other automobile companies are seeming to have come around to Tesla's point of view that the future belongs to hybrids and electric cars, and that future is closer than we thought it was going to be. So to me, that's the biggest change Tesla's wrought. It's taken one of the most hidebound, inertia-affected businesses on the face of the earth, the automobile business, and changed that business. So Tesla's operations are clearly starting to take off. So let's do a valuation update of Tesla. As I look at what's happened over the last 13 months, my story for Tesla is relatively unchanged. I describe Tesla as an auto/technology company, a company that will be able to deliver the revenues of an automobile company while maintaining some of the characteristics of a technology company, the low reinvestment needs, and the growth capacity of a technology company. That story is relatively intact. There are a couple of numbers that I did tweak. The successful launch of the production, at least it's clearly not quite there yet, of the Tesla 3, has made me a little more optimistic about revenues going forward. So, and not necessarily in the near future, but my expected revenues going forward, 10 years out, are a little higher. 92 billion as opposed to 93 billion as opposed to 82 billion from my July of 2016 valuation. The other thing that has moved on the plus side here is Tesla continues to lose money, but it loses less money than it did a year ago. Its operating margin, especially if you clean up for R&D and operating leases, is about -1 to 1.5%, which means it's closer to breaking even, at least on an operating income basis than it used to be. And that's having a positive effect on its reinvestment needs. In fact, while I continue to forecast that Tesla is going to have negative free cash flows for the next 7 years, about 15.5 billion, that's a much lower number than it was just 13 months ago. So slightly higher revenues, less reinvestment. What does that translate into? A higher value per share, at least based on my estimates, of about $192. That's up from $152 about 13 months ago. Still well below the stock price of $365, but the value is moving upwards. Now, if you want to take a fuller look at the valuation, you'll see it on this page where I projected out my revenues and margins. And remember those 7 years of negative free cash flows, the way this is going to be, this is essentially the cash burn. It's what you expect to see in a company like Tesla, growing at a very high rate in a business that requires reinvestment. So that negative free cash flow does not surprise me. And the fact that it's collectively about 15.5 billion doesn't scare me either. That's what you'd expect in a company like this one if it succeeds. In fact, that negative free cash flow by itself would not have worried me, but it's the debt that Tesla has taken on, and we'll talk about this in the next few minutes, that concerns me. And that, I think, creates at least the possibility that if something bad happens, Tesla could tip over into distress. So I've attached a 10% chance that the company might tip over into distress. The net effect of all of this is that $192 per share value that you get. Now, I know as you look at this valuation, you're probably saying, well, that doesn't make sense. I'd have made a different assumption. Rather than bitch and moan about the assumptions I've made that you don't like, I encourage you to download the spreadsheet and I'll put a link up to it, and change the number you don't like. Make it your valuation. Perhaps with your assumptions, Tesla is worth $500 per share or $50 per share. But this is my story and my valuation, and it's entirely possible I'm wrong on these. Now, as you look at this valuation, I'm clear-eyed about the challenges Tesla faces. And as I see it, the three big challenges Tesla will face to get from where it is today to being this established, successful automobile company. The first is, based on my revenue projections, which in year 10 are going to be 92 billion, that will turn out to be about almost 2 million cars that Tesla will have to sell. That's quite a steep climb for a company that sold 94,000 cars last year. Can Tesla pull it off, especially because competition is increasing from not just Volvo, but the other automobile companies? I think it can. And part of the reason I feel optimistic about its capacity to pull off the sales challenge is if you look at the people who drive Teslas, you talk to them, they're intensely loyal. There is something about this company that attracts loyalty that goes beyond, hey, they're just fans of Elon Musk. They love the car. So I think it has the capacity to sell 2 million cars. The second challenge to me is the bigger one. Can it sell 2 million cars? I think it can. Can it produce 2 million cars? Now that's the real question. Because right now, it has a logistics problem, a production problem. It doesn't have the capacity to produce anywhere near, forget about 2 million cars, 500,000 cars. In fact, Elon Musk has admitted that they're facing manufacturing hell. And that's a good thing. At least he's admitting that there are challenges from a manufacturing standpoint. So, in fact, there are two challenges I see in the production side. One is timing. Timing in what sense? Well, all these people who've signed up for Tesla 3s are expecting delivery next year. So not only does Tesla have to ramp up production, it's got to do it quickly. The second is they've got to do it in a way that keeps their costs lower than for a typical automobile company. In fact, Elon's been talking about the fact that Tesla's found a way or is finding a way to bring down the costs of production. I'll believe it when I see it. And he's pulled off enough rabbits out of his hat that this might be another thing that he pulls off. But that's going to be a big part of success here, is being able to change the production paradigm. And the final challenge is, can Tesla, while it's creating these high revenues and producing more cars, get to 12% margins? That's twice the typical margin for an automobile company. I've given it margins closer to that of being a tech company. So it's got to sell about 2 million cars, be able to create the production capacities, and be able to produce margins which are much higher than that. So this is not going to be an easy path by any stretch of the imagination, but it's clearly both plausible and probable. So now let's talk about the part of what Tesla's doing that I don't understand. Now, Tesla is a high growth company. It describes itself as a technology company, and clearly those are things that are going to create negative cash flows that require external financing. But if you look at the way growth companies, especially young companies, finance themselves, they finance themselves with equity for a simple reason. You can use hope, promise, potential as down payments with equity investors and get them to delay their cash flow. So basically, equity investors are okay with that. You don't borrow money because you cannot make interest payments with promise and potential. Tesla, oddly, has been heavily focused on using debt to fund its financing. You can see that in this graph. The debt that Tesla has outstanding in the middle of 2017 is more than 10 billion. And I include their operating lease commitments, which are a relatively small commitment, given their other debt commitments. That's $10 billion in debt. And that debt is built up because Tesla has used debt to fund its financing. And it doesn't seem to be quite done, because now there's talk about $1.5 billion new debt issue, where they're actually going to issue bonds with a conventional coupon of 5.25%. And there's even talk that the bankers of Tesla are going to use an equity pitch to get these bonds bought by investors. Now, I don't get this. Either the people who are planning this pitch do not understand how bonds work. If I buy a bond, I don't get upside, so I don't get any of that promise and potential. The best I can do is collect my 5.25%, but I get a lot of downside. So what's promise and potential going to do? An equity pitch doesn't work on a conventional bond. And the other thing they seem to be missing is that you cannot make these interest payments you're committing to, as I said, with promise and potential. Now, don't get me wrong. I'm not one of those who believes that debt is a bad thing. In fact, debt is a trade-off, and the question of whether Tesla should be borrowing the money can be best answered by looking at the trade-off that animates whether you should be using debt or equity. And here's what you're weighing off. On the plus side, you have tax benefits. The tax code is tilted towards debt. And on the plus side, you also have the potential, at least in some companies, that debt can make lazy managers a little more involved, a little more accountable in the way they pick projects, added discipline. On the minus side, debt increases the risk of bankruptcy, no matter who you are as a company, and increases the potential of conflict of interest. Why? Because what lenders want from a company can be very different than what equity investors want, and here's how it plays out. Lenders either put covenants, restrictions on what you can do as a company, or charge you a higher interest rate. Take a look at that trade-off, and you can see already why Tesla is singularly unsuited to borrowing money. First, on the tax benefit. What tax benefit? This is a money-losing company. It's been losing money forever, and it has almost $4.3 billion in operating losses carried forward. It's not going to be paying taxes in the near future. By my estimates, for the next 5, 6, or 7 years, there is no tax benefit to debt. There is no need for added discipline. The decision making in this firm goes through one man, Elon Musk, who also happens to be the largest stockholder. If he needs debt to make himself more disciplined, we're in big trouble. On the other side of the equation, you got potential for large bankruptcy costs. Here's a company with tremendous promise and potential. Even Tesla's biggest critics would agree on that, which is putting it at risk by borrowing money. In other words, not being able to make those interest payments could effectively wipe out all that promise and potential. Why risk it? And on agency costs, if you're lending money to Tesla, a fast-growing company that's going into new businesses, you're going to be terrified. And the way you're going to show it is by putting in restrictions, by charging a higher interest rate. If I were drawing a prototype of a company that should not borrow money, it would look a lot like Tesla. So why are they borrowing money? There are two answers I can come up with, and neither makes the company or its bankers look good. The first is what I call the delusion bogeyman. What does the delusion bogeyman do? The delusion bogeyman effectively says that any action you take that increases share count is by definition a bad action. So issuing shares, bad. Borrowing money, good. It's a horribly misthought concept, but it drives a lot of decision making. There's nothing wrong with issuing shares, but if you let the delusion bogeyman into the room, you will not issue shares. The other is inertia. A lot of what CFOs and companies do is based on what other companies in the sector have done. The automobile sector historically has funded its projects with a lot of debt. But is Tesla an automobile company? In fact, isn't Musk's argument that Tesla is not an automobile company? It's more technology than automobile in the way it approaches business. It doesn't make sense on either count, but those two reasons I think explain why Tesla is borrowing money. So what would I suggest that Tesla do? Not that Tesla's asked for my advice. One is if it can still back away from the debt issue, it should, and issue equity instead. It fits every characteristic of a company that should be raising equity. Markets love it. It trades at a high price. Promise and potential are working now. Investors are taking it as a down payment for future cash flows. Take advantage of it. If you really insist that you don't want to issue shares, there is a way out. Do what you did in 2014, you being Tesla. In 2014, Tesla borrowed money, but those were convertible bonds with a coupon rate close to zero. A convertible bond with a coupon rate close to zero is all equity. It's a conversion option. It looks like a bond. So in a sense, you're fooling the delusion bogeyman while issuing equity. Go for it. Overall, though, if you look at the story and how it's evolved since July of 2016, there have been more positive steps than negative ones. The story is evolving. It continues to be interesting, and I think Tesla is on its way. The next year is going to be testing. The company is going to approach manufacturing hell, and I'm glad it's recognizing it. The one thing that worries me is by borrowing money to fund this manufacturing hell, Tesla might be putting its future at risk. I would much rather, if I were a Tesla stockholder, that they'd used equity. Thank you very much for listening.